Okay, good afternoon everyone, and welcome to the next session, which is about behavioral finance. I'm joined by Adair Morse. I'm Nick Barberis, very happy to be here with you and see so many old friends. So what am I going to talk about? I'm not going to talk for very long. I'm going to talk a little bit about Chicago Booth's role in the development of behavioral finance. And I guess my theme is that Chicago Booth played a perhaps surprisingly large role in the development of behavioral finance. I'll talk a little bit about progress in behavioral finance and responding to some challenges that Gene laid out for us more than a couple of decades ago. I'll also talk a little bit about the future of the field. Richard and Rob are going to talk about that, but I can't resist saying a few things myself, which they can either endorse or dismiss or likely suggest some better ideas. So I'm going to start with Chicago Booth's role in the development of behavioral finance. I'm going to do a very quick overview of the development of behavioral finance in the past 4 decades, sort of indicating where Chicago Booth played a role. Let's start with the 1980s and 1990s. So on the left are theoretical, conceptual developments. On the right are empirical developments. Of course, there's so much empirical work that's relevant. I'm just going to focus on a few things that had a strongly behavioral theme. And the things marked in yellow are places where Chicago Booth played a role. I'm being a little bit generous. If just one of the authors was at Chicago at the time that the work was done, I'm going to give Chicago credit for it. But I think the broad message applies. So I guess modern behavioral finance started in the top right there with the work of Schiller and Leroy and Porter on excess volatility. The 1980s and 1990s, by the way, are primarily about asset prices because there were a bunch of facts that weren't that easy to explain from a fully rational point of view, so we focused on asset prices. So was the work on excess volatility, and then the work on long-run reversals by DeBont and Thaler, showing that the past 5-year return of a stock was predictive for the future return with a negative sign. So I would say Chicago Booth didn't play that big a role in the early development of behavioral finance. I confess that because of Bob Schiller's heavy involvement, I like to tell myself that modern behavioral finance started at Yale. But having said that, it turns out Stephen Leroy actually did spend a year here, I think in 1979 to 1980, where he was presumably working on excess volatility, so maybe Chicago had a bit of a role there too. Okay, and then we move to the conceptual side. The first major conceptual theoretical work in behavioral finance was on noise trader models, right? They're not psychological. They're these models where in one period some people might be over-optimistic, in the next period they're over-pessimistic, and so on. DeLong, Schleifer, Summers, Waldman. I guess Andre was here from 87 to 91, roughly. Presumably, he worked on that a bit while he was here. And some of that theoretical work fed into the work that Andre did with Richard Thaler and Charles Lee on closed-end funds, on how the prices of closed-end funds are different from net asset value. And of course, again, Andre being here from 87 to 91, presumably he did that work in part here. Next major thing on the theoretical side, of course, the famous work on limits to arbitrage, responding to the arbitrage critique that maybe rational people can neutralize any mispricing caused by the irrational people. Andre had left by then, but of course Rob was here and worked on it while he was here. Next development is more psychological models, and you can think of this as psychological models of beliefs first and then psychological models of preferences. And I guess 2 of the best known psychological models of beliefs were developed in part here at Chicago Booth. The work that I did with Rob and Andre, we worked on that while Rob and I were here. And Kent left in 1996, but I'm pretty sure that he had started thinking or working on his famous Daniel Hirschleifer-Subramanian paper before he left. Let's go to psychological models of preferences. One of the very famous early papers here is Benazzi and Thaler on the link between loss aversion and the equity premium. I guess Dick arrived here in 1995, so that paper was written before he got here. But a lot of the work that it inspired, for example, the stuff that I did with Ming Huang and Tano Santos, was written again here at Chicago Booth. On the empirical side, there was then the famous work by Brad Barber and Terry O'Dean on investor trading behavior. Chicago didn't have a big hand in that, but they had more of a hand in the work on the technology stock bubble. Famously, of course, Lamont and Thaler, Owen and Dick were both here. Mitchell, Polvino, Stafford, also a famous paper on this, but I think they started that work after Eric left here. There you go. There's even more Chicago than we thought. Exactly. Okay, it's an open session. You can claim even more than what's on here. I think there's plenty of yellow. Don't be greedy, okay? Okay. Okay, notes on the 80s and 90s. So yeah, Chicago was quite involved in the development of behavioral finance. A lot of the debate about rational versus behavioral approaches took place here. Initially might seem surprising, right, because we always think of Chicago as the place that really promoted the rational view, the rational approach to thinking about markets. And I guess that is true to some extent. It did promote that view, but I think it's also a place that really likes to be in the middle of important debates in finance, and this is one of the most important debates we had, and so I think they wanted to be part of it. And I give Chicago Booth a lot of credit for taking part in the debate, because in the 80s and 90s there were a lot of schools that were quite skeptical of behavioral finance, but they often took a sort of silent approach. They didn't really want to get involved. Chicago Booth, to its credit, did get involved. Just as a matter of record, the debate in the 1980s and 1990s was vibrant, sometimes heated. So now we tend to be nicer to each other than we were back then. So people coming into behavioral economics now think that it was always as happy and peaceful as it is right now. But it wasn't the case. Back then, it was sometimes heated. If you look at the June 1993 issue, for example, of the Journal of Finance, you can really get a sense of it, the back and forth between Merton Miller and Lee Schleifer and Thaler. I don't think there's been anything like it ever since in the Journal of Finance. You really sense the intensity, the heat is coming off the page. So it wasn't always very comfortable, but honestly right now I look back on it in an entirely positive way. I just think that it was a bunch of people who really passionately cared about getting to the truth, and they had different ideas about how to get to the truth. That was all it was. And to state the obvious, Richard Thaler's arrival here in 1995 proved to be very significant in many ways. He was a mentor to many people here, including to myself. But more important than that, I think he really forced Chicago Booth to have this debate. You know, he came to the finance seminar back then most weeks, and he wasn't shy about putting forward the behavioral point of view. So he really forced us to have this debate, which was very important. All right, back to the development of behavioral finance. Let's do the 2000s and the 2010s. Honestly, in the 2000s, Chicago, I would say, was less involved, but it was also a quieter time for behavioral finance. It wasn't as vibrant as in the 1990s, but there were significant developments. There was behavioral corporate finance, for example, the work of Baker and Wergler on rational managers responding to shareholder irrationality, for example, issuing more equity when shareholders were too excited. The work of Malmendier and Tate, which was more about irrational CEOs, overconfident CEOs doing too many mergers, for example. Wouldn't say Chicago was too involved in that work. Then there came behavioral household finance, which was trying to understand the mistakes that households make in their financial portfolios on psychological grounds. And Chicago played some role in that. Adair did some work on that. Sam Hartzman did some work on that. Alex Yemas is now doing great work on this. But even more, maybe the next thing that came along, prescriptive behavioral finance, which was, let's not just try to explain what's out there, what people do, but let's try to help people make better decisions. Obviously, a key idea there is this nudge work, of course, done in part by Thaler and Sunstein, who are both here at the University of Chicago. And the 2010s was, again, we came back to asset prices, but this time it's the second wave of behavioral asset pricing, largely about people's beliefs, and to a large extent this was motivated by survey data, renewed attention to survey data, people's expectations about future returns, their expectations about future earnings growth, the theory that inspired extrapolation models, an important type of extrapolation model based on experience effects, where you're extrapolating from your personal experience. And Chicago, again, has been involved in this through the work, for example, of Stefan Nagel and Juran Ma and Francesca Bastianello and so on. So I hope you get the big picture. Chicago Booth, surprisingly, I didn't even, until I sat down to do this, I hadn't realized quite how involved it was in the development of behavioral finance. Might seem surprising initially, but maybe it's just because Chicago Booth wants to be involved in the big debates. So one thing I wanted to mention is one critique during the somewhat sort of hostile time of the 80s and 90s that was leveled at behavioral finance was that it had a potential for lack of discipline. So the extreme version of this critique would be, anytime there's any kind of puzzle in financial markets, what the behavioral guys do is they just grab the psychology book off the shelf and they leaf through it until they find some piece of psychology that seems to explain the thing they want to explain, and then they declare victory and go home. And the argument was, because there's a real risk to this, because there are dozens of ways in which people are irrational, so you can literally, I suppose, flip through a psychology book and find something that would explain the thing you want to explain. And Gene, in a famous paper in 1998, he warned us about this. He said, given the demonstrated ingenuity of the theory branch of finance and the long litany of apparent judgment biases unearthed by psychologists, it's safe to predict that we will soon see a menu of behavioral models that can be mixed and matched to explain specific anomalies. So he sort of warned us about this. And one thing that sort of I realized just a few years ago is, well, this may be one case where Gene's forecast was not correct. And one thing that's really struck me is, yes, we've explored lots of ideas in behavioral economics, but the center of gravity in behavioral finance has really remained in a remarkably small set of concepts, which I would really list as just three, really: over-extrapolation, overconfidence, and prospect theory. And just to be a little bit more precise about that, if I were to write out for you what are the main frameworks we use in behavioral finance, they can fit easily on a slide. These are the main frameworks. So on the belief side, it would be over-extrapolation models, where you over-extrapolate past returns or past earnings growth. Yes, there's various flavors of that. There's the classic extrapolation models, there's diagnostic expectations, there's experience effects, but they're all really about overreaction to recent news. And then there's the work on overconfidence about signals. There's a mild version of that where if you're overconfident, you get differences of opinion across people, and if you throw on a short sale constraint, you're going to get overvaluation. There's also a more aggressive version of that that sort of Kent and co-authors adopted, where you can get misvaluation even without short sale constraints. If a lot of investors do some digging, they find some good signal, and they're overconfident about their analysis, they're going to push prices up too high. And on the preferences side, it's pretty much all motivated or inspired in some way by prospect theory. So again, we've explored lots of ideas, but the center of gravity in the field has remained remarkably consistent in these three ideas. And while I may have seemed a little, as if I was daring to criticize Gene, a forecast he made that was not correct, actually, I want to turn it into a compliment, because I think we actually stayed disciplined in part because of Gene's warning. I think we were a bit stung by sort of Gene and others' critique about lack of discipline, so I think we were careful not to stray too far from some core ideas. I want to talk about the future, but first let's briefly take stock of the present, the progress in behavioral finance over the past few decades. Here are three quick things. Certainly the research on limits to arbitrage is very important. Also, empirical work documenting facts that are hard to explain from the rational paradigm, things like whether it was the stuff on closed-end funds or the tech stock bubble, or even things like momentum. But perhaps most important, it's the development of increasingly sophisticated, psychologically grounded models of important things that can compete with the rational models on things like the aggregate stock market, the cross-section, bubbles, individual investor behavior, real estate market. For each of these 5 things, there's increasingly sophisticated behavioral models, psychologically grounded, that compete with the rational ones, and that are gaining traction, I think, relative to the rational ones. So, for example, the aggregate stock market. This is just my personal observation. I'm seeing graduate students being less interested in working on the classic rational models here, like habit formation, long-run risk, rare disasters, and more interested in working on the behavioral ones. And I think in part because these models are consistent with more data, for example, survey data. For example, for the aggregate stock market, when prices are high in the aggregate stock market, if you look at investors' expectations of future returns, they're often above average expectations of returns or neutral expectations of returns. Less commonly do you see them have lower than average expectations of future returns, which is what the traditional models would predict. So I think that is swaying some people towards the behavioral side. On the cross-section of stock returns, the traditional theories will say, stocks that have higher average returns, it's because they're riskier. But if you look at survey data on risk, what do people really think is riskier? The stocks that are supposedly riskier, they don't actually think are riskier. So that, again, gives us pause. And again, I want to talk about the future, but just 30 seconds taking stock. I'm honestly very encouraged about where the field is today, having been involved in this field for sort of 25 years or something. Right now, I'm seeing more high-quality papers in this field than ever before, and I'm struck by the number of very talented young people who are working in this area, as we saw on last year's job market. So last section, I'm just going to say a few things about the future, and I'll be interested in Richard and Rob's thoughts on this as well. We're going to pick out a few ideas on what's important for the future. I guess fundamental things like understanding the drivers of overreaction, right? It seems like big things like aggregate stock market fluctuations, the value premium bubbles, all of them smack a bit of overreaction, but the question is, what's causing that overreaction? Currently, popular view is that it's due to over-extrapolation of past returns, over-extrapolation of past earnings growth into the future, but is that the right approach? And if not, what is the right approach? And whatever answer you have, you need to make sure it's consistent or can also explain the instances of underreaction that are out there. And again, this is something that Gene warned us about a long time ago. He just sort of pointed out that if you don't have a theory of when there's under versus overreaction, that's potentially just consistent with efficient markets, which will produce individual instances consistent with under and overreaction. He writes, if anomalies split randomly between underreaction and overreaction, that's consistent with market efficiency. So this is one of the big, long-standing challenges in behavioral economics. And here's like a simple summary in terms of the evidence that looks like underreaction, evidence that looks like overreaction, drawn from experiments or from surveys or from markets. The experimental evidence is the most clear-cut. You may know those classic balls and urns updating tasks where people strongly underreact to signals, but there's also all this stuff on base rate neglect and representativeness, which suggests overreaction to information. If you look at the surveys, you probably know there's this new tool, the Koybon-Gorodnichenko regressions, where you run a regression of forecast error on forecast revision that can help tell you whether people are under or overreacting to information. And what you see, interestingly, is underreaction to some things when people are forecasting near-term earnings or near-term interest rates, but overreaction when forecasting other things like long-term earnings growth or returns or some other economic variables. If you go to markets, of course, here where it's most speculative, but certainly things like reaction to earnings news seems like underreaction because of the post-earnings announcement drift. Even momentum suggests underreaction, but things like excess volatility bubbles and a value premium suggest more overreaction. So a classic question is, how do you make sense of all this table? And to boil it down, a specific challenge I can throw out is, whatever theory you have for overreaction with excess volatility bubbles and the value premium, how is that consistent with the experimental results, a simple updating tasks where you see strong underreaction to information? How do you make it consistent? The good news is that in just the past 2 or 3 years, there's been real progress on this difficult question. So a whole bunch of studies just in the past year or two have come up with interesting results. So there's evidence of more overreaction when the evidence you're given is weak as opposed to strong, which is where people tend to underreact more. Interesting paper on this by Augenblick, Lazarus, and Thaler. Alex Emas has some related work. You see more overreaction when people are forecasting processes with lower time series persistence. You see it both in experiments, you see it in the surveys as well. You get more overreaction for assets that have more fat-tailed fundamental distributions. You see more overreaction for signals where people are paying more attention. So we still haven't figured out this whole thing. There's a lot more to clarify, but I'm encouraged that we can and have made progress on this difficult question, the difficult challenge that Gene threw out a long time ago. A few other things for the future. Understanding what we can learn from survey data. And what worries me a little bit today is some people pay a lot of attention to survey data, others aren't really paying much attention to it at all. I think we should all pay attention to the survey data and try and understand what we can learn from it, because it can potentially tell us some important things. I mean, it's now a large-ish literature, but just a kind of quick summary at the kind of aggregate market level. Some of the findings are the market's price to dividend ratio co-moves positively with analysts' expectations of long-term earnings growth. When prices are high in the market, analysts have high expectations of long-term earnings growth. Interestingly, analysts' long-term earnings growth, that variable predicts returns at the aggregate market level with a negative sign. And moreover, there's evidence that these expectations of long-term earnings growth are driven in part by past growth in fundamentals. So it's very consistent with a picture whereby there's hear some good news, and that makes people too excited about the future. They push prices up too high. Then they're disappointed and prices come back down. It's very consistent with that. And there's also similar analogous evidence with return expectations. If past returns have been good, some investors then form overly positive expectations of future returns, pushing up prices. They're then disappointed and prices come back down. Of course, the survey data raises all kinds of questions. Are they capturing people's true expectations? Are people partly reverse engineering these expectations from prices? So when prices are high and we ask analysts for their long-term earnings expectations, are they just looking at prices and then giving you a number which just sort of matches the high price? And given that things like returns and earnings growth are really hard to forecast, do we think that people are confident enough in their stated beliefs about these things to really adjust their portfolios a lot and hence to impact prices? So great questions, some of which have been raised here at Chicago, but my broader point is I think we should all engage with these survey data because potentially there's something to be learned here. What I would say is if we had good data on people's expectations of future cash flows and returns, that's very quickly going to unlock a lot of the mysteries of asset pricing, I think. We don't have perfect data, but we have reasonable data, so there's a lot to potentially learn here. All right, last few things. Prescriptive behavioral finance. How can we help people to make better decisions? Of course, there's the famous work with nudge, with retirement saving, auto-enrollment, auto-escalation, and so on. But still, there seems like there's so much more to do, right? Households are making so many mistakes persistently. How can we help them to make better decisions? I don't think we're working on that quite enough. I worry a little bit that we're subcontracting that to the non-academic authors who write the personal finance books. And as we know, they often say rather different things from academics. So are we comfortable with that? It seems there's potentially a lot more to do there. Revisiting behavioral corporate finance. There was this very influential and highly cited work I mentioned earlier in the 2000s from Baker and Wergler and Malmendier and Tate, but it hasn't really continued after the 2000s. I haven't seen very much in the past 10 to 15 years. So I think behavioral corporate is in need of some new ideas, some new inspiration, and perhaps someone in this room can figure out what that might be. And drawing connections between behavioral finance and machine learning. There are so many aspects to this. Just the one I wanted to mention is that I think we can perhaps learn something about the working of the human brain from the algorithms that computer scientists use, and that could be useful. The classic example is reinforcement learning. So reinforcement learning is, of course, an algorithm that computer scientists use to solve complicated problems, but it's also used by psychologists because they think it could be, in part, a good model of the human brain. So there's strong connections between the machine learning that computer scientists do and the psychology that we in behavioral finance are interested in. And the very last thing I wanted to say, and I'll wrap up with this, is the other thing that could be really good is to have more interaction between researchers on the rational and behavioral side. And the reason I say that is I worry today that with finance being such a huge field, we all tend to specialize in our own area and read the papers in our area, and we don't have time to read the stuff that's going on in other areas. And I think that can really slow progress. Back in the 1990s, finance was a significantly smaller field. It was harder for the rational and the behavioral guys to avoid each other. The rational people had to confront the behavioral work. The behavioral people had to confront the work more on the rational side. It wasn't always comfortable, but I think it was good for progress. So this is something that worries me. Perhaps we can figure out a way to handle it. I'll stop there. Thank you.
Okay. Thanks, Nick. The problem with following Nick is being as precise or as smooth. Right? So I'm starting with Wikipedia, and I need the clicker. The natural place to start, of course, is Wikipedia because we get all the insights here. The reason I'm starting with this quote from Thaler from the Nobel Prize interview with the Daily Telegraph is because I want to talk about humanity. And most of behavioral finance has been in asset pricing side, right? More than the corporate, but in the beginning and then into the household. So I want to use this agent. I want to come back to this agent point here in a moment. So here's my origins slide, which I was hoping that Nick would cover, the efficiently prospecting for tulips and agents. And the reason I mentioned this, that I wanted to include agents in this framing, is from the corporate and household side, the beginning of starting to think about agency and people making decisions, humanity here. And so Jean had the 1980 paper talking about this, and of course the roots down into agency costs and people making decisions, and how contracting, this matters in terms of our mentality when we hit household finance. I think this made a big difference. So I'm not going to go into this. This is mostly already covered today in different forms. The 1980s and 1990s, this was, Nick and I corresponded a bit, and so not covering here as well. But the idea here of the disruption in 1980, now my lack of precision is when, who was where, like the people do when there's a Nobel Prize, the university claims them throughout their history, so I'm going to act that way as well. But the idea here of thinking about people and how they actually act, not how our model said was a big disruption, and the disruption I would say that moved us forward. But let's go to corporate finance. So in corporate finance, we were, in the 80s and through the early 2000s, we were thinking about humanity in terms of governance downfalls, right? Obviously, Chicago played a huge role here. Vishney Schleifer and Luigi's work on social capital culture, as well as all the agency work here, the Coasian tradition and theory. All of this stuff is not behavioral finance, right? But it's all about agents making decisions, and was the foundation for the contracting approach that Nick referred to in terms of thinking about the Malmendier and Tate work on thinking about the way people behave either in the self-control environment or in the overconfidence. So what is the point here? That in a way, this is the only slide I have on this time period for corporate finance in behavioral. It was thin, right? The paper that in a sense has made the most indentation here, and the Depression Babies, Stefan's paper, is still enormous work on this field, right? But why did we end up here with this going not in directions that we're still talking about? And so I'm going to come back to this as we move forward. But at this point is when household finance started. And so we're at this point, and the mindset of people coming into this is very much about, people are making mistakes, and how are we thinking about interaction those mistakes in terms of what the wrongdoing for themselves or the wrongdoing for some sort of, what do I call it here, the fluid purpose in the agency model or public goods, common good setting, right? So now we have household finance. So the early forerunners here, so Barber, Nodine, obviously. So Annette's job market paper, which ended her up at Chicago, also in this area, Heaton and Lucas, right? Some early work, all on portfolios here. And then, of course, we have to think about the retirement work that's not Chicago, and French Perturba, Kowal Moskowitz on local biases, right? This early stuff on portfolio decisions. Again, very much as Campbell summarizes in the presidential address, it's very much in the mistake framework. Then phase two was we started thinking about other financial services. So this is where I had good timing on, working on the payday loans right after John Campbell's presidential address. Brian Meltzer from Toby Stewart from here. Then this is a really thin list, but other pieces of starting to think about financial services and how those financial services might use what they know about how people behave to optimize for profits, as opposed to optimize for consumer welfare. So financial advisor work, Amit's work with Gregor, the other financial advisor work with Antoinette, just really compelling stories on financial advisors. We never talked about it. Advertising, I like the advertising work that Marianne did with the folks on the international sector, just for understanding reaction, and again, Ahmed and Gregor working on advertising. There's a whole list here. I could go on about the number of papers, the current generation, and you have just a phenomenal group of folks in Chicago working on household finance issues. Just an amazing set of people working on design and student loans, health finance, just keep going and keep going. So this is literature has started, and then the Great Recession hit, which on a personal note was really nice, because being here at Chicago as a young person, all the boys were here, and the boys all had the same BMW, and they all sat in the lunchroom and debated whatever it was we were going to debate that day, the table or whatever it was. And thank goodness the Great Recession hit, and we all just got quiet and listened to Doug Diamond for a while, right? And so that was just such a delight. And I hope we edit that out. But we started then to think about real estate. Obviously, the work here on behavior and what the mechanisms are of understanding real estate piece, and Ralph's work on health insurance and how those decisions are made. So now we're starting to actually think about things. But the point of the field here in this slide is that we were still very much in the dismal side of mistakes and financial actors kind of taking advantage in some way, right? This whole literature for this whole time, we're still in that mentality. And I'm partially to blame. My office was next to Dick's office, and we weren't paying attention to what Dick was saying, which was, stop just saying people are making mistakes and do something about it, which to me is just the phenomenon. As I was preparing this, I was a little bit just awestruck by why weren't we listening? And why did it take us a while? So Dick was talking about the Say More for Tomorrow defaults, right? The libertarian paternalism, which I read again a couple of days ago, is just kind of amazing thoughts. And then, of course, the nudges work, right? And so this was really one of these aha moments, right? The first, the 1980 moment, when we actually started to write down things that Nick and others just have really move forward, but that moment of Dick's, the initial paper, they're writing it down, and then this moment of we need to actually help people. And so there's a number of remedy papers that have come out of Chicago. Marianne and I worked on the information paper. I want to mention the whole accounting side of disclosure, right? I have the bias that a number of folks in finance have, that when you think about disclosure, it's like a mechanism. It's not a mechanism. It's a way that maybe changes behavior. And Christian's been working on this the whole time. And maybe we need to pay attention to understanding what both sides of the accounting side are. Devin Pope's got some amazing work on triggers. The commitment devices, Xavier Ginet is a Chicago graduate, working on these things in different contexts, really amazing work at the World Bank. Neil, when he was here, and so forth and so on. Again, right? This is what your young generation is working on, is design in terms of these remedies. So we owe the first generation and Dick a lot of credit for perhaps making us think different ways. We still have lots of problems. Have we done all the remedying? No. Financial services get better every year at mechanisms of extracting the rents. I think of Susan Athey's work on this, which is not Chicago, and in her work, if you think about the early innovation on that, is we can take industrial organization, market design, embed machine learning underneath it, and you get to a point where you can extract all the rents, right? You can learn everyone's preferences. And when you do that, you're at the mercy of whoever's providing the services, at the mercy of extracting all the rents. And so this is kind of where financial services are. These are big, sophisticated companies. And it's really important to think through as we go into technology. I have one more technology slide on that, and I'll come back to it in a minute. All right, I'm going to take a disjoint moment and talk about in-group biases for a second, which I consider behavioral finance. So the starting point on this, I'm going to talk about Marianne Sindel's paper, Emily and Greg. we knew about gender and race gaps, right? That was not new. We also knew that loan officers probably are racist sometimes, right? We kind of had that in mind. Or you can put in a different, hiring people have racist preferences as well, perhaps sometimes. But what this paper did, which if you look at the number of citations, it's shocking in the way that the paper made it tangible on, the mechanism is so clear, right? If you read that paper, it's just like, you can't not believe it. And so when we all read that paper, and it was this aha moment of, we used to think that we can, when we solve racism, we're going to solve this problem, and this came out that we're not solving this problem. And so, there was a large effect, and it's so stark that the everydayness of this mechanism really glares at the reader. And it's clearly suboptimal for both sides, right? That's the punchline. So this paper has been tremendously important and relates to the next slide about technology. But first, let me talk about also this Devin Pope paper, which is really interesting, just early looking at visuals and how we react to visuals in terms of lending decision. So now fast forward to technology. Okay, so I'm putting up a picture here of a paper I wrote, but mainly just to show the picture. The histogram here is once you take out credit risk using the GSE credit risk model. So this picture is interest rates with the credit risk taking out. So there shouldn't be a distribution here. The histogram should collapse to almost to nothing because there's no credit risk left. And so the pricing shouldn't be different. So why in getting a quote for a mortgage are some people quoted different rates than others? Right? That's what this picture is showing, is that there's a distribution. And the answer is that mortgage lenders price based on expected behavior of whether you're going to take the offer, including shopping, your expected shopping. Are you going to shop around? What is your expected willingness to pay? Do you trust or do you hate financial services? So for many minority communities, they don't have a great past with great history with the banks, right? So they don't want to go to another bank. They don't want to go to another financial services. So maybe they're more likely to take the first offer. And other things you could add in that we can program, right? All this becomes programmable. So again, back to the Susan Athey thing I was just saying, is that you can get the algorithms or the AI to program out optimal rent extraction from each individual based on expected shopping, expected trust, expected all of this stuff. And so it becomes really important to understand how much of this we need to think about going forward. The other paper I wanted to talk about on this subject comes actually from Science. My references are Wikipedia and Science here. This paper by Mulanathan et al. I really like it's a health paper. It's not a household finance paper. But what the paper does is it looks at the effect of a scoring algorithm on patients receiving care. And it finds that for a given level of the risk score, the Black patients are sicker. And so what that means is that for a given level of risk scoring, the Black patients are receiving worse care if the hospital is using this algorithm to decide who gets what kind of care. And the reason, and this is why this important thing, is the target for the algorithm training is not sickness, but it's healthcare expenditures. So let me try to say that differently. So you have a training data set and a target. You want to train the data set on a target. The training data set, the target, if the target is not actually the objective function, you're going to get a biased training data set. If a human is programming the training data set, you also get a biased. If the variables you put in there are correlated with race beyond the reasons, you also get a bias, right? There are all these biases in the process of the training data set. and the way we develop the algorithms, because there's humans involved and because we don't have perfect measures for everything, that can lead to just enormous biases. And the more we get into the AI economy, the more we're going to end up with outcomes like this. Now, that's not to say that AI is not and algorithms is not getting rid of from some of this face-to-face racism bias as well as the in-group bias, but nevertheless, there's a lot to be done here, and there's a lot to be afraid of here. Okay, my last slide, well, second, I have a summary slide, but I also have a frontier slide. My frontier slide is a little bit comes out of my experience the last 2 years at Treasury, and let me just say something about this economic revolution thing, because I think corporate needs to come back to behavioral. So Nick has already stolen my punchline there, but at the moment we're sitting in a situation with supply chain disruptions that we learned in the pandemic in Ukraine, as well as whatever you want to believe on climate, but the disruptions and the change in the transition economy in transport and energy. And these are all enormous. And so we are overlaying that with AI, which is going to disrupt a lot of labor. That we are in the situation of things need to change, and corporations are acting in status quo, right? How can you think about how you do accounting, HR, business development, labor, anything, if you're not understanding where future revenues are coming from? And how can you understand where future revenues are coming from if you don't understand where your labor shortage is going to be? It's all integrated. And we're not understanding decision making with this lens in mind of the integration of all the fields we teach at business schools. And so perhaps this is a good time. It matters a lot in terms of the investments and things that we look at in corporate finance. And so maybe it's now a good time to rethink about how we make decisions and how we do or do not interact with others in terms of figuring out remedies, taking the insight from Dick in terms of let's go right to remedies and thinking through these situations and not just on the problem. Finally, let me just mention the ESG point here, which ESG really has nothing to do with this thing. And I'm going to use the pro-social behavior term, even though financial economists don't use that term. But the idea of impact investing or investing with utility function that is over more than just money, right? What is my take here? So Lubos has work here. Luigi talks about the subject in slightly different terms, but as I've been doing this at Treasury, I ran climate for some of the Treasury side other than tax. There's a lot of friction in terms of corporate decision making that comes from short-termism and investor relations, right? And there's a lot of momentum in terms of in what's happening in the world, which is not where the momentum is in research, but the momentum in what's happening in the world is in thinking about pure monetary plays as well as opposed to plays that have something to do with pro-social, and where do we understand the overall equilibrium of the economics of climate change, the economics of environmental inputs into our decision making, and how does that play out? And it's hard to model, disentangle those things because of short-termism in the way decisions are made by corporations as well as investors. So I'm not convinced that this is the pro-social utility function idea here is what is the, it's certainly relevant in many portfolios, but it's not relevant in enough of the money that this is where we get to climate mitigation. That's not saying it's not an interesting subject, but we need to step back and say, wait, how do we actually get portfolios that tilt the cost of capital, perhaps in a different way, perhaps this way, but I feel like we need to understand more here. Okay, that's all I have other than just summing up here. Breakpoint moments, 1979-80. Let's actually model the aha, let's stop being judgmental. These are, the Dick Thaler and others in those fields. The really could that happen moment, that's the in-group bias work. And then the new behavioral finance moment where we are today, AI and algorithms is just too huge a subject, one cannot ignore. And then human agents in uprooting times is pretty important. So that's all I have. Thanks.
Great. I think we have a little time for any reactions, comments, thoughts. Do we call on people? Stefan, go ahead, please. Oh, we need to wait for the microphone. Yeah.
Okay, so I just want to offer some thoughts on this kind of lack of a second wave of behavioral corporate finance that Nick mentioned, and Adair you also touched on. It's an interesting point. I was kind of wondering what the reason is. And if I think about the second wave in asset pricing, I think the availability of lots of survey data was key, and that a time series of survey data have become long enough that you can do useful things with it. And I'm wondering whether that's kind of the reason why in behavioral, in corporate, we haven't seen that second wave yet take place. But I'm wondering whether we are kind of right now, maybe at the right spot, where this could happen. We don't know all that much about what's going on in managers' heads when they decide on corporate policies. Cam Harvey and John Graham pioneered a survey many years ago, but there are not a whole lot of other data sources. And now there's a lot more textual information available. For example, my colleagues Kilian Huber and Niels Gomsen here have been using earnings calls, and there's tons of other textual information that one probably mine now with the tools that are available these days to learn a bit more about, how do managers come up with a discount rate? What are they thinking when they set a discount rate? And some fundamental things like that I think we still don't understand. Anyway, just a thought.
I think it's a really good point. One thing I might say is, I think one challenge that behavioral corporate has faced is that I think it faces particularly tough competition from more traditional frameworks in corporate finance, which are quite rich. You've got the agency framework, you've got the asymmetric information framework, which are quite rich, have lots of great predictions. I don't want to say that traditional asset pricing isn't rich, but I think there's a sense in which traditional corporate finance is even richer and more of a competitor for behavioral approaches.
Nikki provided a very insightful sort of history of the development of ideas from in the 80s on. And to that list, I would add two names who actually were at Chicago and worked in the 70s and 80s and worked before even the name of behavioral economics was coined. That was Hillel Einhorn and Robin Hogarth. And in those days, indicated later that there was some kind of tension between rational economists and behavioral. There was no tension at the time, and I think the reason is that the two groups did not communicate it very much. Those were sort of psychologists doing their own thing, and then economists were doing their own thing.
Yeah. And that's my fear a little bit, is what's happening today is the rational people are doing their thing and the behavioral people are doing their thing, and they're not talking as much as they should be. It might be uncomfortable, but it might be necessary.
So Nick remember the time of tension. So I think it's good to remember the time of tension, because I think that a lot of the good work has come from this tension. But also one of the questions that a lot of people ask is, why there is this conference? What is the common theme in Chicago? And I think the common theme is that maybe there is not a common thing, that people actually debate, sometimes vehemently, different ideas, but they do debate them, one against the other, but in a very civilized way. And I want to remember this factoid, because this is both the symbol of what I think Chicago is about, and also some lessons one can learn. When Dick came and gave the first class here, I sat through his class, and the very last class, he invited Gene, and they had a debate about their views of the world. And so imagine, at the time, none of the two had the Nobel Prize, but I think it was easy to forecast at least Gene at the time would have a Nobel Prize. And so the fact that the students are have the opportunity to see two people like this debate in front of each other. I think that that's what Chicago is about. And the second lesson is I have to say that, sorry, Dick, but Gene is a much better debater than Dick. However, I think Dick was right. And so what I want to sort of draw is not always the one with a better argument is right. You have to separate between the ability of people to make a point and the substance of the point. And this, I think, is a very difficult thing to do, and that's what I want to pass on to the younger generations.
That is a good point. Gene, your microphone.
Sorry. Yeah. Oh. We have this world where you either think fast, you can think fast and you can think slow. So how do I know in advance which way to go? So what I'm saying is, can you set up experiments in which you predict in advance which way, whether you're going to have persistence or reversal, and then we go test? Because I don't see that. What I see is always ex post rationalization.
But I think this is another thing that we learned from Eugene, because even back in the 1990s, you were saying to us, oh, I want testable predictions. And to be fair, I do think that the behavioral literature listened to you. I mean, it's not that I can list all the examples right now, but if I think about the work that Malmendier and Tate did on overconfidence with CEOs, they didn't just say, oh, CEOs are overconfident, that explains excessive acquisition activity. No, they came up with different measures, they had a bunch of predictions of the hypothesis, they tested them. Same thing in investor behavior. We don't just say, oh, people are overconfident, therefore they trade too much. People try to come up with, let's try and measure overconfidence and see if the empirical results line up with the predictions. So I honestly do think that we listen to you, and there's a lot more testing of prior stated predictions in the literature than you might think.
I'm going to just come back to Stefan's point about behavioral corporate finance, and since you mentioned the overconfidence again. I've always thought that and maybe this is wrong, but in a corporation, behavior averages out, right? It's not just one person making a decision. And I'm not sure that's right? I mean, so I remember Antoinette and Marianne and others that I guess Ulrike has a paper about the managers, right? And identifying there's a manager effect, right? And how much, what's the magnitude? The interesting thing in there is not that there is, but what's the magnitude of that leading to outcomes? And I wonder, if we're thinking about where we are now, I mean, and you think about Elon Musk, but we were there in the 80s and 90s too with also big CEOs. And what is the role of one versus many in an agency relationship? That was my reaction since you've said that question. That's why I think we haven't had, the first wave was not that big, other than your paper on experience, which is different, right? But so I'm not sure where that goes, but I do think, answering your question later, I think we have to come back to it and understand that, particularly since the corporate form as we know it is changing a bit, right? And AI is going to make it change more in the role of labor and scarcity of labor and labor going across firms in different ways. So I do think it's relevant to rethink those things. So sorry to delay answer.
I wanted to also relate to this manager debate, because I think, in some sense, I think why the second wave of corporate finance and behavioral in a way looks muted is because I think actually the corporation is a place that has realized that people have behavioral biases and other problems too, just, have problems understanding the world. And so a lot of governance is also around trying to mute some of these behavioral issues that CEOs have. So you have as Nick, you said, right, the agency models have often very similar predictions to behavioral models, and on top of it, you have agency governance models set up to counteract them. And I think that makes the testing so difficult. And I do also think we've maybe been a little bit too sloppy in really modeling these different channels because we didn't have good data. And so I think you're right, totally, Adair, that the more we now get internal data and very fine-grained data from corporations, we will be in a much better, kind of setup to see this. And just a plug, I mean, there is work actually on this, but it's much more been in organizational economics. So, people like Rafaela Sadun and so on who have looked at, the diaries of CEOs and how they, use their time, and in particular in family firms where the governance might not be so strong, right? So we do see, I feel there's a lot of exciting things to be done. But it's almost like in a lot of things I think we do in economics, right? There's really now a challenge for measurement and metric. And I think in asset pricing, you were always on the frontier of measurement, better than corporate finance, but hopefully we are going to catch up.
Yeah, that's a great point.
Hi, Alex Simas, I'm faculty here. So to that point, I think the data is getting a lot better on the management side. So there's a new hire here at Booth, Virginia Minnie, who's got this amazing data set of managers, and she kind of follows up on this work of manager effects within firms with finding really striking results for manager quality. And David Thesmar has a new paper on managers and kind of forecasting expectations within the firm. So I think probably the data issue is kind of catching up to the asset pricing side.
Just a point on that, it would be great to overlay the managerial thing with the other thing I mentioned on the slide prior to here in terms of the disruptions in supply chain and all of these different changes that are going on and what firms are facing in the outside environment, politics aside, right? And so I think that becomes really important for us to rethink that in terms of the data, not just as an exercise in of itself, but understanding where business development, where M&A, what the issuances are for, different things that we study in corporate finance.
Anil, you're our timekeeper. How are we doing on time?
Got a minute.
Okay.
Last question. Yeah.
Has anybody thought about how would you organize the decision process in a corporation or any kind of organization in order to neutralize the effects of biases?
Yeah. So Jean asked about neutralizing biases. Actually, I think corporations are really interested in that. When they ask academics to come and talk about some behavioral issues, that's one of their top topics. What can you tell us about that? And I think other people in the room may be more expert on that. But if I just briefly say, group decision-making biases like conformity and groupthink and so on, there are things that people have studied in terms of how to get around those things. And they can be simple things like the leader of the group plays a really important role, must make sure not to state their view in advance because then everyone else in the group just follows along with what the leader says, and the leader needs to work really hard to extract each person's unique information with respect. And so there are these things that can be, it is being studied, it could be studied much more, I think. It's not easy to study, it could be studied much more. And practitioners are incredibly interested in this. So if you do work on this, there'll be a huge audience.
Seems like a way to make money.
Just building on that, the at this moment in time, needed in the room is not different layers in one area of the corporate divisions, but you've got to have a supply chain, a business development and accounting, a legal, whatever. You have to have the spectrum. So leveling the hierarchy across divisions for the decision making eliminates a lot of that up-down stuff, and it's what's needed anyway in the economy. So I think that's, we also need to be teaching that way because that's how solutions are coming out.
Thanks so much for your comments and for listening.